Worldwide markets this week. US inflation. I think we're going to get a September rate cut back there. Share buybacks, good, the ugly. Sasol update. The market is loving it. Trump, China, and tax on chip sales. I'm Simon Brown. This is Worldwide Markets, episode 643 for 13 August. I'm recording this Tuesday afternoon. Worldwide Markets, powered by Standard Bank Global Markets, Retail, and Shift, the global money app that puts travel, shopping, payments, and investments in the palm of your hand. Enjoy the cheapest forex rates anytime, anywhere. Shift, powered by Standard Bank. Thanks to Standard Bank, thanks to Shift for the sponsorship. Let's kick off with US inflation because that's the big breaking news. It came out about 20 minutes ago as I'm recording. So normal inflation, it was 2.7 for June. Expected was 2.8. It came in 2.7. It's not a bad number. In fact, it's quite a good number. Core was previous 2.9, expected 3, and came in at 3.1. Perhaps a less good number. But a quick look at US futures. We've got the S&P up 0.2%, the Nasdaq up 0.75%. Both of those looking a lot better than they had been an hour ago when I last checked. They were both green, but they were up about a tenth or so. So we have got Jerome Powell and his team, FOMC rate cuts. 17th of September, and then 18th is our own. I think we're going to get a rate cut from Jerome Powell and his team. The inflation number was not knocked out the park, but I think that if we look at what they were expecting in terms of inflation, in terms of the impact of the employment data, look, the revisions were nasty, but the unemployment rate wasn't a horror. These inflation rates aren't a horror. I think it's time maybe we will see that rate cut coming. And the market is going to absolutely love that. It is currently pricing it in. Our own market is also responding in kind. We are trading up 0.7%, trading at all-time highs, and I don't think that's going to necessarily change anytime soon. So yeah, market is absolutely loving that inflation data. So far, so good. And something else the market is loving is Sasol. So they came with a trading update. So remember they had a production update. When was that? That was back 22 July. The market hated it because it just said, yeah, results are going to be more than 20% higher. Well, duh. I mean, we knew that at mid-year because you turned a profit after a loss in the first half of the year. We've now got the details for Sasol. This is for the full year ending June. HEPS expected to be between 33 Rand 60 and 36 Rand 30. That puts it at the bottom end of the range on a PE of under 3. Under 3. Sasol is cheap. There is no doubt about it. Sasol is cheap. The question is if you want to be a shareholder in it. That's a different story. They certainly have challenges. But interestingly, the 6 months ending December, in other words, at the half-year point, they'd done 14 Rand and 13 cents. They've done even, let's take sort of towards the bottom of the range, let's say they're going to do 34.13. They've done 20 Rand in H2, versus 14.13 in H1. In other words, things are picking up for them and looking better. The chart doesn't massively thrill me. We can see some jumps all over the place. It certainly gets interesting in the higher 100s. Let's see where it goes for now. There is certainly a lot of resistance. Trading 92.99 as I speak, 9.7% higher. As I say, market absolutely loved them. Finally giving some details because it was a production update, and then the trading update, as I said, just didn't say anything, and that certainly spooked folks. They were like, hang on a second, what exactly is happening here? We've got an event coming up later in August. It is on the 26th of August. It is a Standard Bank Power Hour, SA-listed property overview and outlook. It is with Keelan Ndlovu. He is, I think, one of the top-rated REIT experts in South Africa. He's going to focus local, but he's also going to touch on offshore. He's going to look at, we've had a really, really strong 2024. And frankly, 2025 hasn't been not half as good, but hasn't been bad if we consider. So he's going to go over a look at what are we seeing in terms of debt levels? What are we seeing seeing in terms of NAVs, any particular local stocks that inspire him, and what about potentially some offshore as well. JustOneLap.com/events for more information and booking. You can attend the webcast. You can also attend live at the Standard Bank head office, Baker Street, Rosebank, Johannesburg. I mentioned our ETF database a couple of shows ago. It was still in beta. I didn't give too much data back then. We officially released it on Monday. It held up. So you'll find it at justonelap.com/ETF database. It will get onto the menu. It'll have its own space. These are passive ETFs. We will be adding actively managed ETFs in the next week or 10 days. Then we're going to start doing ETNs and AMCs. They're a little bit more complicated, but they're there. What we have is the 88 ETFs that are currently listed. You can search by issuer and say, just show me from a certain issuer, whichever one you particularly want. You can also do by fund classification. So we've got local and offshore income, local and global equity, local and global REIT, and then, of course, commodity. There are a couple of commodity, and then a global multi-asset as well. And you can request to look at tax-free or not. It's only the commodities that are not tax-free. But if we take a quick squiz here, you can go and pick, but you can also, you can search. So you could say, for example, in the search box, you could search for Nvidia. Now, there are no ETFs that are Nvidia, but there are ETFs that have Nvidia as a top 10 holding, and it'll then say to you, these are the ETFs with that top 10 holding. So you can go and click through. And in the case of, let's go have a look at the One Invest 5IT. I hold it. It's a great tech one. And you click through by clicking on the instrument code, and it tells you that Microsoft is 21.25% of the ETF, Nvidia 18.74%, Apple, Broadcom, and so on. That is as per the MDD minimum disclosure document as of 30 June. We are taking the data from the minimum disclosure documents. You can also at this point go and search for articles that would have on Just One Lap that have referenced that ETF, so you can get more information there as well. If you've got thoughts, if you've got things you think that we need to change or upgrade, let us know. Simon at justonelap.com, and certainly we will add it to the list. For now, it is functioning and working. As I said, next will be the actively managed ETFs coming soon. So I want to talk on share buybacks. I got to say, I back in the day was not a massive fan of share buybacks, and my logic was fairly simple. Far too many companies did them at horrible prices. I remember JD Group doing buybacks at 100 Rand a share, and a year and a half later, the share was $30. I remember Anglo American doing share buybacks at extremely elevated levels. I can't remember the price, but then a couple of years later, the price was under pressure. The problem is when the company's got all the money on hand to afford them, well, then the shares are at elevated prices. And when they haven't got the money, then the shares are at depressed prices. That's just how it rolls. But in the US, share buybacks are huge, and there is a key benefit. So you pay me a dividend. Just to keep it simple, keep it South Africa. You pay me a dividend, I pay 20% dividend withholding tax. You take that cash, you buy back the shares. Well, I can effectively benefit from there being a lower number of shares in circulation. I hold a little bit more, own a little bit more of the company, and I haven't paid tax. President Biden was looking to change that loophole to close it. I can't see Trump closing that loophole, so it'll stay as things stand right now. They projected to buy back $1.1 trillion of shares this year. To be clear, that's only a little over a quarter of an Nvidia, but still, it is a big number. The biggest purchaser, Apple, at 100 billion. So here is the Apple share count, and it peaked in April of 2013 at 26.460 billion. It's now down at 14.8 billion. That is a 44% decrease in terms of the share count. It is essentially eating itself, which is not a bad thing. Now, Apple has truckloads of cash, and we could argue that they've been buying it at points when the share was fairly elevated. But what this means, and let's keep it simple, let's pretend that the share price, that the share count halved. It means your shares got twice the ownership it was before. Let's put it another way. There's a company with 10 shares in issue. You hold one of them. So you own 10% of the business. The company goes and buys back 5 of the shares, dematerializes and tears them up and throws them away. You still hold your 1 share, but they're only 5. So whereas you held 1 of 10, that was 10%, 1 of 5 is 20%. Your ownership has grown, your dividends and time will grow, and so on. There are the T's and C's. Companies that buy back shares at elevated prices that can significantly destroy wealth. But there's another T's and C's, particularly in the startup space, the CrowdStrikes, the Palantirs and the like of the world. What they do is they are buying back shares at points perhaps, but at the same time they are issuing shares to staff. And the issuing of shares to staff, I hate because it's considered a non-cash item, etc. It's not cash, but it is diluting me. It's the inverse, right? There were 10 shares in issue. You owned 1 of them. The company issued 10 new shares to staff members. Now there are 20 shares. You still own 1. You used to have 10% of the company. Now you've got 5%. And we see this, it is extreme in some examples in the US tech space in terms of the issuances of new shares in lieu of paying for returns. And in lieu of paying staff bonuses, you give them shares. Just a quick thing. I'm actually going to be writing about it on Wednesday. It'll be out on Thursday. The Satrix Resi. So the Satrix Resi is it's not that much of a weird beast. It's a resource index. It does exactly what it says on the sticker. It is the top 10 largest resource stocks in South Africa on the JSE, and you put them together, and you've got the Resi index. It's capped, but don't worry about that. And I was buying it for much of 24, and I think even maybe a bit in 23. Not because there certainly was at around that 53, 55 level, a nice level to be buying. And the reason I'm buying is because at some point, commodities go crazy. I just didn't know when. I knew it would happen. So it's happened. It's happened thanks to gold. That index is now probably more than 60% gold miners, and then PGMs, and then a bit of Sasol, and a little bit else. But certainly, it has been a phenomenal return. This is what I want to show, which is the performance year to date, 72.5%. And it was down on Tuesday. I don't have yesterday's data here, so that's where we sit right now. For comparison, Satrix 40 up 25, India up 16, and the Finny up 5.7. That is a staggering return. Now, was I super smart? No. For me, it was dead money forever. And I remember for much of 24, it really was going nowhere. That all the time, SA Inc. was doing great. And I'm like, I'm on a bus, but I'm on the wrong bus. The thing with the Resi or resources, they will at some point go crazy. That is just absolutely going to happen. You just don't know at what point. And we can see a number of fake moves going through, but this year, and it pretty much started, I think December 27 was the start point. It has just gone absolutely crazy. And the question is, does it stop anytime soon? So gold is an interesting one, and I've been having this asking a number of people their views on gold and where it's going. Gold is range bound. That's just it. It's trading between the low 32s and the mid 34s, low 34s. $200 range. It's been range bound. Chatted about this before. It got into this range in April after the Trump tariffs and has gone sideways. What makes it break higher? We've already got tariffs like crazy. We've already got Trump firing the head of the Bureau of Labor Statistics. We've already got him threatening Jerome Powell, although he will leave that until May. We still haven't been seeing any rate cuts in the US this year. Remember when we were expecting 6 cuts last year, never mind this year. So what makes gold jump higher? I'm scratching my head. Earlier in the year, I spoke about a potential of a $4,500 gold price, and that is still possible. Certainly, we've got central banks buying. Certainly, they are de-dollarizing. They're buying less dollar assets, and that mostly, of course, being US treasuries. But I'm not sure what sends it on its next leg. If it stays at these levels, our gold miners are probably comfortable with current prices. Key point, dividends. When I spoke about gold earlier in the year at 40, saying it could do 4,500, and in fact, if you go to justonelap.com/podcast, Power Hour. You can find an entire presentation I did on gold. At the end of last year, for the results to December 24, some were mid-year, some were full year, the gold miners had got an income per ounce of around $2,200, and they were making probably about $600 each per ounce. T's and C's, depending on the miner, maybe it was 500 at some, but you get the picture. They're now making, let's call it 3,200. That's an extra $1,000 an ounce after they only were getting, say, 600. That's almost tripling their profits. And let's assume they're not doing stupid stuff like buying back their shares. Let's assume that it is going as most of it is going to go. Get rid of debt and pay back shareholders in terms of dividends. It's nice, it's simple, and we like it. Last point I want to chat about. So Trump tariffs. South Africa apparently sent another proposition to Trump on Tuesday. Tariffs on South Africa, currently 30%, minerals excluded. I have no idea what's in that. But a couple of things. So Trump has delayed the China tariffs for another 90 days. To be clear, there are tariffs on China, and I can't even remember where we are with the China tariffs, but the really, really horrible ones are kicked down the can for another 90 days. We've got Nvidia and AMD have reportedly agreed to pay 15% of revenue on their AI chip sales to China. Now, there's some backstory here. Nvidia can't sell the Grace Hoppers and the like, and I don't know what the AMD equivalent is to China. So what Nvidia and AMD did was said, well, let's us make a B-grade chip, which does a lot, but instead of doing the training, it's just sort of doing the answering of questions in the LLM models, the large language models. So they're not as powerful. There's the the H20 from Nvidia, and they were specifically designed for China. They made a truckload of them, and then Trump said, you can't sell them. And then they wrote them down. And then Trump said, you can sell them. And then they wrote them back. And now they've got to give 15% to the American government. To be clear, they're not giving it to Trump. But frankly, if they were, I don't think any of us would be that much more surprised. This is a shakedown. I was listening to Daily News Tech Show for Monday. They went into the details. And in terms of the Constitution, it's probably not illegal, but someone's probably going to sue. I mean, just because it's America. It earns Treasury, based on previous year's sales, it'll earn the Treasury about $5 billion a year. That's about 2.5% of financial year 26 expected sales. And to be clear, these were chips that Nvidia and I imagine AMD had essentially written down because they thought they couldn't sell them to China. They've now been given a special dispensation. China is making their own chips of equal quality, because these are not the Grace Hoppers and the Blackwells and the like. These are, as I said, the H20s and stripped down chips. And China makes equivalent. They just can't make them fast enough. So the likes of Alibaba, Tencent, JD, and the others have been scrambling to get these Nvidia and AMD chips. However, there are reports that came out a couple of hours ago, Tuesday morning, saying that the Chinese government warns against buying the Nvidia H20 chip. So I don't know where it stands there. Trump is absolutely doing a shakedown. No one should be surprised by that. But here's my fun fact for the day, which I think is telling in a number of senses. And it is quite simply the Chinese trade surplus. You would think that with all the trade wars and everything, etc., that trade surplus would be under pressure. It is at records. Absolutely. It's a 12-month cumulative, 1.2 trillion US dollars. For comparison, they were at 400 billion just at the financial crisis 2016. They got to 600 billion, and they're now at 1.2 trillion. And this is what's shaking out, where countries are saying, okay, so trade with America is complicated. Let's just say that. Let's see if there aren't other places we can trade. And China's like, hey, hello, remember us. And that is certainly what we're seeing. And probably we're going to be seeing, I think, a lot more of it in the weeks, months, and years ahead. As frankly, and I've been saying it since day one, Donald Trump severely damages the US brand and ultimately economy. Worldwide markets, powered by Standard Bank Global Markets, Retail, and Shift, the global money app that puts travel, shopping, payments, and investments in the palm of your hand. Enjoy the cheapest Forex rates anytime, anywhere. Shift, powered by Standard Bank. Shift, SHYFT.co.za. Go have it a look-see. Thanks to them and Standard Bank for the sponsorship. We will leave it there for today. My name is Simon. As always, I will be back again next week. And if you can, look after yourself. And if you really, really can, look after somebody else as well. Cheers all.